Every so often, a single headline changes everything. But the real story? Well, that's never the one you read first.
February 28, 2026. A missile crosses the Persian Gulf. It's part of a joint U.S.-Israeli airstrike, Operation Epic Fury. The target? Iran. The result? Supreme Leader Khamenei is killed. Almost instantly, the region ignites. The Revolutionary Guard Corps vows revenge. And then the missiles start flying. Not just at Israel, but at Bahrain, Kuwait, Saudi Arabia. Even Dubai and Doha are in the crosshairs.
And the market's first reaction? It's exactly what you'd expect. Buy oil. Buy oil stocks. It's the obvious trade, right? And for about 6 hours, that trade worked.
But while retail investors were piling into the obvious trade, the smart money was doing something completely different. They were making a bet that had almost nothing to do with the headlines. They saw through the noise to a much deeper, much more profitable reality. And over the next few minutes, we're going to pull back the curtain on that exact trade. We'll show you what they bought and, more importantly, why. Because here's the thing. This story isn't really about a war. It's about a fundamental shift in the entire global energy map, a shift that's been hiding in plain sight.
Okay, so first things first. Why does one missile in this one part of the world send the entire global market into a tailspin? Well, it all comes down to a tiny, ridiculously important strip of water.
20 million. Just let that number sink in for a second. That's how many barrels of oil squeeze through the Strait of Hormuz every single day. You can see it on a map. It's this tiny little choke point between Iran and Oman. At its narrowest, it's just 33 kilometers wide. But it's not just a strip of water, it's the planet's energy-carotid artery. 1/5, 1 out of every 5 barrels of oil the world burns flows right through there. Saudi oil, Iraqi oil, Kuwaiti, Emirati, you name it, it has to get through Hormuz. So you can imagine what happened when Iran threatened to shut it down. The world didn't just worry, it panicked.
Now here's what's so fascinating about this. When you hear the word blockade, you're probably picturing warships, maybe some sea mines in the water. But in the 21st century, you don't need all of that. You don't need a single ship to shut down the world's most important waterway. All you need is fear and a keyboard. Within hours of Iran's threat, the big shipping lines, we're talking Maersk, Hapag-Lloyd, they just stopped. All transit suspended. And then came the real kill shot, the insurance companies. The big players in London canceled all war risk policies for the region. And that's it. Game over. No insurance, no captain will sail, no bank will finance the cargo. And just like that, you get what's called an effective blockade. It's this eerie vacuum out on the water. Hundreds of supertankers, just anchored in the Gulf of Oman, too scared to move. The world's oil artery just clamps shut. Now, look, I know what you might be thinking. This all sounds a lot like the 1970s oil crisis, right? Gas lines, economic chaos. But there's a huge difference this time. America's role in this story has completely flipped. Back in '73, we were a massive net importer. We were incredibly vulnerable to shocks from the Middle East. Today, thanks to the shale revolution, we're the world's biggest producer, a net exporter. But here's the thing you can't forget. Oil is a globally priced commodity. It doesn't matter if we produce it here. When the price in Europe or Asia goes to the moon, our price follows. There is no escaping the pain. But strip away the war, strip away the fear. What you find underneath is honestly far more unsettling. So that brings us to the price of oil itself. And this is where we get into the big trap that so many people fall into. Because buying oil stocks right now, it feels like a sure thing. But what you're really doing is making a bet on this war continuing. And that is a very, very dangerous game. Here's the thing you have to get about oil. It's two things at once. On one hand, it's a physical barrel. It's the real stuff that gets refined into gasoline for your car. But on the other hand, it's a financial asset. It's a ticker on a screen that traders buy and sell. And in a war, that financial side gets completely distorted by emotion. When traders in New York or London see missiles flying over Dubai, they aren't buying because there's a shortage today. The tankers are still full, the wells are still pumping. No, they're buying because they're scared of a shortage tomorrow. And that extra amount they're willing to pay, based on pure, uncut fear, well, that's what we call the fear premium.
And this chart breaks it down perfectly. Before all this kicked off, the market consensus was that oil should be trading around $60 a barrel in 2026. People were actually worried about too much supply. But right now, Brent crude is at $80, so you can see the split. That $60, that's the fundamental price. It's based on actual supply and demand. But that extra $20, that's the fear premium. That's the war. And this is the most important point. If you're buying an oil stock today with crude at $80, you're not making a bet on fundamentals. You're You're betting that this $20 of fear is going to stick around. And let me tell you, history shows us that war premiums are ghosts. They can vanish, literally overnight, on a single headline. A single tweet about de-escalation, and poof, it's gone.
Because once the headlines fade, and they always do, the price of oil comes back to this fundamental three-way tug of war. You've got supply on one rope, mainly controlled by OPEC Plus and U.S. shale. You've got demand on the other, which is all about how healthy the global economy is. And then you've got the ref in the middle, finance. The strength of the US dollar and, of course, speculation. These are the forces that actually matter in the long run. The fear premium is just noise. Here's what's been hiding beneath the war headlines for the last 5 years. And honestly, it's a much, much bigger story.
To really get where the true opportunity is, you have to understand the story of the last decade. And that story really is the American shale miracle. I mean, it's the single reason oil prices didn't go to $200 a barrel years ago. It changed everything. But that miracle has a dirty little secret, and it's a secret that's about to change everything all over again. You know, there's this quote from Alice in Wonderland where the Red Queen tells Alice, "It takes all the running you can do to keep in the same place." Honestly, I cannot think of a more perfect metaphor for what's happening in the U.S. shale industry right now. For a decade, shale was an absolute revolution. It took the U.S. from being a declining power to the world's #1 producer. It broke OPEC's back. It felt like we had infinite oil. It completely changed the game from risky exploration to something more like a repeatable, predictable manufacturing process. But here's the thing about that manufacturing process. It has a fatal flaw.
See, when you drill a new shale well, the first few months are just spectacular. It's like shaking up a champagne bottle and popping the cork. The pressure is immense. A brand new well in the best part of the Permian Basin in Texas, it might roar to life producing 1,000 barrels a day. The cash flow is just incredible. It looks like you've printed a winning lottery ticket.
But here it is. Here's the dirty secret of shale. Fast forward just 12 months. That same well is now producing maybe 350 barrels a day. That's a 65% drop in 1 year. And this isn't a fluke, it's just the physics of shale rock. Unlike a big conventional oil well that can produce steadily for decades, a shale well gives you everything right up front and then just fades incredibly fast. And this creates what we call the Red Queen effect. You have to drill new wells, constantly, at a frantic pace, just to keep your total production from falling off a cliff. You literally have to run as fast as you can just to stay in the same place.
And as if that treadmill wasn't hard enough, now the geology itself is starting to fight back. I want you to think of the Permian Basin, the heart of the shale boom, as a giant cup of bubble tea. For the last 10 years, the drillers have been geniuses. They stuck their straws right down to the bottom of the cup, where all the best, tastiest pearls are. That's what we call Tier 1 acreage. It's the sweet spot, the best rock, the highest pressure, the most oil. But after a decade of drilling thousands and thousands of wells, the best spots are gone. The pearls have been sucked dry. And now, these companies are being forced to drill up in the watery, less tasty part of the drink, the Tier 2 acreage, where there's less pressure, more water, and much higher costs.
And this lays out the brutal math of that shift. Before 2020, when companies were hitting that prime Tier 1 rock, a new well could make money with oil at, say, $40, maybe $50 a barrel. It was a fantastic business. But today, in 2026, they're drilling in worse rock, and they're dealing with a new problem called well interference, which is just a fancy way of saying they're drilling new wells so close to old ones that they're actually stealing each other's pressure. Now, the break-even price for a new well has soared between $65 and $70. And then there's the final nail in the coffin, Wall Street. After getting absolutely torched in the 2020 price crash, investors have put these companies on a leash. No more drill, baby, drill. Now, it's all about capital discipline. They are being forced to return cash to shareholders, not pour it back into a treadmill that's speeding up. Here's the bottom line. The shale boom didn't collapse, it just grew up. It matured, and a mature shale industry cannot save the world from an oil shortage.
So, if shale can't ride to the rescue, the world has a really big problem. It needs to find huge new sources of oil. And this brings us to what is, without a doubt, the single biggest mistake that most investors make when a crisis like this hits. They hear oil prices are going up, they open their brokerage app, and they buy the first oil stock they see. An ETF, a big major, whatever. This is a massive, massive error, because not all oil is created equal. You have to think of the oil industry as a long chain. First, you have the upstream guys. These are the producers, the drillers. They're like farmers. Their entire livelihood depends on the price of the crop. In this case, the price of oil. They're totally exposed. Then you have midstream. These are the pipeline and storage companies. Think of them as the toll road operator.
They don't really care what the price of oil is. They just get paid a fee for every barrel that moves through their system. It's a much more stable business. And finally, you have downstream, the refiners. These guys are manufacturers. They buy crude oil and turn it into gasoline and jet fuel. They make money on the difference between their input costs and their output price, something called the crack spread. So for them, super high oil prices are actually bad for business. Understanding which part of the chain you're investing in is, well, it's everything.
And this brings us right back to the central idea here. That $20 war premium we talked about, the part of the price based on fear, that's temporary. It's a gamble on headlines. It's a sugar high. But the structural shortage of barrels, the fact that the world is running out of the easy-to-get oil and the shale miracle is over, that is not temporary. That's a problem that's going to take years, maybe a decade to solve. So, the smart money? They're not betting on the war. They're focused on the only possible solution to that much bigger, much more durable problem: finding massive new supplies of conventional oil.
And when you're looking for huge new supplies, there are really only two places to go. You can drill more shale, or you can go offshore, into deep water. But economically, it's not even a contest. Look at this table. For every $100 million a company invests in shale, they might get, on a good day, 4 to 8 million barrels of oil. But that same 100 million invested in a successful deepwater project, you're talking 100 to 300 million barrels. It is just an order of magnitude more efficient with capital. And the cash flow couldn't be more different. A shale well, like we said, is like a junk bond. You get a huge coupon for about 18 months, and then it's basically worthless. A big deepwater discovery is like a 20-year U.S. Treasury bond. Once you get it up and running, it produces steady, low-cost, predictable cash flow for decades. Given that the shale treadmill is breaking down, it's not just an option for the big oil majors to go back to deepwater, it is an absolute economic necessity.
And this, right here, is where the whole story pivots. For the better part of a decade, deepwater exploration was the forgotten stepchild of the energy world. It was hated, it was starved of capital, it was completely overshadowed by the shale boom. But now, it has suddenly become the only game in town, the only viable path forward. The oil majors know this, the smart money figured this out, and that realization has created one of the most severe, most interesting supply and demand imbalances I have ever seen in my career.
So let's go back to our original question. What was the smart money frantically buying in the hours after that first missile strike? It wasn't ExxonMobil, it wasn't Chevron, it wasn't barrels of oil futures. No, they were buying the companies that owned the picks and shovels of this new gold rush. They were buying the owners of the high-tech deep-water drilling rigs. Because here's what happened. When the Exxons and the Shells of the world finally woke up and came to the market in 2026 with billions and billions of dollars ready to spend on new deepwater projects, they discovered a terrifying fact. After a decade of bankruptcies, neglect, and scrapping ships for parts, there were almost no drill ships left to rent, at any price.
So that leaves us with one last massive question. If the only solution to the world's looming oil problem requires a very specific, very complex tool, what happens to the price of that tool when it simply doesn't exist in the numbers required? What happens when the thing the world needs most is the one thing it can't get? Markets reward the people who do the work before the crowd shows up. You just did the work. See you in the next one.